Welcome to the Wealthsteading Podcast. This is episode 454. Today is October 3rd, 2024. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. I've been way behind in getting out content, and today's going to be a real quick episode because I'm very short on time. But I'm hearing from a lot of people that are concerned about everything that's going on in the economy. Israel's fighting battles on all fronts, and that continues to escalate every day. Hurricane Helene has left devastation from Florida to North Carolina and parts in between. Probably the worst hurricane in terms of damage that we've had since Katrina. The East Coast longshore workers are out on strike. Most European countries are on the verge of recession. Things have gotten so bad in China that now they're printing money and adopting monetary practices like we haven't seen there since the Great Recession. And then to top it all off, we're about 5 weeks away from a presidential election where the electorate seems like they could potentially go either way, and for the most part, no one's happy about it. And yet with all that said, look at the stock market, look at the major indices, and we continue to be at or near record highs. That's one of the big things I hear from people too. They're very concerned that the market's peaked and we're headed to a major bear market, 30, 40, 50% crash. Listen, I have no idea. I can't predict the future. I say that so frequently because you really don't hear it anywhere else. All the other experts and thought leaders and influencers and talking heads, and whether they're on mainstream media, social media, alternative media, they all know exactly what's going to happen. It's all about to happen. Any minute now. It's begun. It's the next turning. Listen, I think all that's BS. Nobody has a clue what's going on. Not the Federal Reserve, not the White House, certainly not some guy on Substack or TikTok. For all the people that think that the market's going to crash any day now, well, listen, it certainly could. But all those people so far this year have been wrong over 40 times because I think within the last week, the S&P 500 had put in its 43rd record high this year alone. I know it's crazy. I know it doesn't necessarily seem to make any sense. And don't get me wrong, I'm not Pollyannish. I'm not always looking for the next new high in the stock market. I was way late getting into this particular rally that we're in right now. And it was because last year, I really thought there would be a recession. Not because of all the gloom and doom, inverted yield curve, and the typical opinions you heard as to why people thought we were going to be in a recession last year, but there were some key fundamental and numeric-based reasons that I thought we would have a recession in 2023. My gut instinct, even with all that, was that we wouldn't have a recession only because so many people thought we were. And from a contrarian perspective, when most of the people think something's going to happen, it either already has and they've missed it, or it's not going to happen, simply because everybody's positioning themselves that way. My key concerns from last year, for the most part, have gone away. Corporate profits, especially those beyond the Magnificent Seven, the other 493 stocks in the S&P 500, and more importantly, mid and small cap companies, those profits are starting to increase. We hadn't seen that for some 22 months. But as of last quarter, we are definitely seeing an improvement and a broadening out in corporate profits, especially down to those lower and smaller company levels. That's a good thing. That generally means you're not in a recession. And then finally, when you look at leading economic indicators, although they have been severely depressed for the last 2 years, really, that has to go with what I mentioned a previous podcast I did where I talked about manufacturing being in a recession. Well, we haven't come out of that yet, but the other general leading economic indicators are holding up and mostly improving, and a lot of that is really because services are still very productive and they're expanding enough to really carry through the overall economy, even though there is this manufacturing slowdown globally. I'm already taking more time than I wanted to on this. Bottom line here, though, let's get back to those small and mid-cap companies. Right now, those companies, for next year, their corporate profit expectations are potentially going to be higher than 15%. Now, I'm not anywhere near that enthusiastic. And I think Wall Street is going to have to back up those numbers. But even if those small and mid-cap companies can improve their profits by, say, 8%, well, that would be a huge win. And in overall dollars, it pales in comparison to what the big Magnificent Seven make. But in terms of keeping the economy stable and keeping workers employed, I think that's where the stability from the economy will come from. The majority of people in the economy work at smaller and mid-size and even little micro companies. And as long as these companies are staying in business, they're employing people, and that's what continues to drive the consumer market, which eventually drives the whole U.S. economy. In any case, bottom line here. If you have fears and concerns and are paranoid about general economic conditions, look beyond your own personal situation. Look at the broad stock market right now and the areas that have grown and continue to grow. And that gets back to where I've entitled today's episode, Power-Thirsty Economy. Because that's exactly what we have. We have a power-thirsty economy. Look at what's going on now with power consumption and power generation. Yes, it's still heavily based on fossil fuels. But the real story in fossil fuel is the United States production of natural gas and petroleum. That's one of the reasons why right now there's a raging war in the Middle East, and the oil markets generally don't care. I mean, Texas Intermediate's at maybe $70, $72 right now. If this was 25 years ago, oil would be at $150 or more. But today, the U.S. produces over 13 million barrels of oil, its own oil, the largest oil producer on the planet. If you go back just a decade ago, the U.S. was barely producing 5 million barrels a day. So the shift in energy markets has been drastic and focused on the United States in the last decade or so. And you combine that with the advances in alternative energy, and now, more importantly, and what I really want to emphasize in today's episode, is we are moving towards nuclear energy like we haven't moved in the last 60 years. You've got to go back to the 1960s to when the United States and other major developed economies were really pushing and moving towards a nuclear-powered grid. Well, when you had events like 3 Mile Island in Pennsylvania in 1979 and the meltdown at Chernobyl, and then in more recent times, the Fukushima nuclear disaster, well, all those things put a kibosh on nuclear power. All that is shifting. You've probably seen that Microsoft is doing a deal with Constellation Energy to restart the 3 Mile Island nuclear facility. There are other companies that are bringing nuclear reactors, new ones, online. There's a whole industry emerging in small-scale modular nuclear reactors. That's where a lot of the money is going to go in the coming decades. And those new energy sources are going to be even more impactful than what the shale oil revolution has done to the U.S. and our economy just over the last decade. They're going to magnify things by probably 100 or 1,000 times. The United States and the world is moving towards better energy sources. That's what's always driven the economy in the past. That's what's going to drive it in the future. And the future is already here and now. I mentioned Constellation Energy. That's in my portfolio, along with many other energy-related stocks, whether they're specifically related to nuclear or uranium, or to power generation through utilities, or just old traditional ExxonMobil oil-type stocks. I not only have an emphasis in my portfolio for these energy and energy-related stocks, but also for the corollaries to those. And that's the technology and industrial companies that I think are going to be consuming that energy, and the consumption of that energy really spins off and means that more and more industrial companies have to supply the grid and the infrastructure and the technical support to produce the energy so that it can be used by technology companies and large manufacturers and industrial companies. Just look at the tech sector alone and artificial intelligence. The tech sector now has been a major consumption of U.S. electric power. I mean, you go back to the 1970s, one of the reasons we weren't building all these power plants anymore is because manufacturing was offshoring from the U.S., and really the only increase in electrical consumption that we had in the United States was from air conditioning. It was from people moving from New York to Florida or Arizona. And then as the tech sector grew, demands for data centers have expanded. And now with more reshoring of manufacturing, and you add on to that what's going to be happening with artificial intelligence, and you have almost unbelievable demands of energy and electricity, and specifically nothing like we've seen in the last 50 or 60 years here in this country. And none of that exists in a vacuum. So the expansion and the development of energy creation and production feeds on itself, and just to keep the system supported, the system has to get bigger with all those ancillary industries and workers and infrastructure. So while I have no idea where the stock market's going tomorrow or next week or next month, long term, I continue to build and orient my portfolio to own good quality profitable companies that are producing energy and power and electricity and oil and natural gas and nuclear energy and technology and healthcare and all the little gadgets and gizmos and widgets that are going to consume and be used by that energy and all those demands. In short term, I can't predict at all what's going to happen with any of those companies. But long term, I think they're going to be profitable and thriving. And so there you have it. I ended up putting more time into this episode than I'd planned. I am very pressed for time today. I appreciate your listening, and I appreciate your patience as you await for me to put out new content. And I promise to be back with more. Until then, as always, this is John Pugliano wishing you the very best returns.